Oh my, today was one of the most incredible days you will ever experience as an investor. The S&P 500 was up 5.5%, the Nasdaq was up over 7%, and the Russell 2000 was up over 6% today, largely due to a cooler than expected CPI inflation number this morning, where the market is more hopeful that the Fed will become more dovish moving forward. We shall see if that is in the cards or not, but at least for one day, there is a massive celebration for the bulls as they had their best day since March and April of 2020. Quite an incredible feat. So we'll take a look at all of that and see what it means for our postures. Undoubtedly, there's going to be some major movements on a day like today, and there's been a lot more bullishness that has now been inserted into the system. So we'll review that from the broad markets perspective. We'll look at interest rates and bonds. We'll talk a little bit about cryptocurrencies and commodities, some sector analysis, and then at the end of tonight's video, I wanted to focus on a bullish trade setup on a utility stock that has 67 years of dividend increases under its belt. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 10th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these daily videos. Also, at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals. I can't imagine there's going to be a whole lot of oversold signals here in tonight's video, but maybe a few overbought ones. So be on the lookout for that when you get your email tonight. Also, keep in mind we're heavy users of Twitter. If you're not doing so already, I'd encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And my, oh my, it was one for the ages. As we look at our S&P 500 heat map here, this I think is what heaven looks like if you're an investor. So rarely will you ever see a day that looks like this. I mean, it's truly, once every so often in a blue moon, you'll see something like this. For those of you that aren't aware yet, we'll get into this when we review the charts, but the S&P 500 was up over 5% today, the whole index. So it is extremely rare to see all of these green, especially the bright green, showing up as consistently as they are. You can kind of see down and to the left here, they have the heat map legend, just a kind of a basic way to interpret this, where the brightest reds are the ones that would be down 8%, and the brightest greens would be the ones that are up 8%. And today, we probably have the majority of stocks, or at least close to half of them, that are in that brightest shade of green. I mean, this was not just some random situation where a couple of stocks were up and really overwhelmed the market indices. We're talking about the entire market just all out in one fell swoop, just making a huge leap higher here today. For those of you that may not have caught the news yet, the reason for this is the lighter CPI reading that we received this morning. So keep in mind that that particular economic number comes out before the market opens. And so as soon as that number came out, I mean, it was just like a massive gap on the futures contracts. And immediately the stocks all started just going crazy to the upside. And sometimes you have those types of mornings where it catches a few people off sides, they trip them out of their stop losses, and then they whip them back the other direction. That did not happen today. Not only did people get caught off sides, but they kept on getting off sides as the day went along. The bullishness kind of built upon itself as the day went along, which was also somewhat encouraging for the bullish case, because again, so many times we've seen those whimpers in the past where you have what looks to be the start of a really good day and then they just pulled the rug out from underneath of you. We did not receive that today. Instead, as the day went along, more and more strength picked up upon itself. And so I thought that was a really good sign there as well. But really quite the morning, quite the day. Many of you know that I do the 9 at 9 every morning on our website, and some of you will see that where I posted on Twitter and elsewhere as well. But just pointing it out today, because today was one of those rare days where at 9 a.m. Eastern Time, a half an hour before the market opened, there weren't even 9 stocks that were down, at least of the criteria that I use, which is pretty rare. Normally, you can find at least 9 stocks up and 9 stocks down in the pre-market. But today was such a one-sided day that on the 9 at 9 graphic, there were only, I think, 4 or 5 stocks that were actually down. Normally, I'm going to have 9 on there. So anytime you see that type of behavior on my 9 at 9 in the morning, you kind of get a sense as to what kind of a day it's going to be. Like I was mentioning to my premium members in my Q&A class earlier today, much more often is the case where you see it the opposite way on the 9 at 9, where it is such a terrible day in the morning that you can't find in 9 stocks that are even up. So it's a lot. It happens much more often that there is just heavy selling before the market opens. This was the rare time where it happened the opposite way, and boy, oh boy, was it ever a massive signal for the markets to keep on roaring here in this case. So, it's hard to pick out. Usually when I'm doing this segment of the video, I'm trying to find where there are some patterns, where there's, some areas that are more consistently bullish than others, but I mean, heck, throw a dart. The whole darn market was up today. I mean, we're talking about some massive movements. Just to put this into perspective, here's Alphabet, a $1 trillion company. It was up 7% today. We're talking about like creating $100 billion worth of market cap with the snap of the fingers. Here's Apple, another $1 trillion company, in this case a $2 trillion company, up 9% today in one single day. And no, they did not report earnings or have any other special number that they reported. They were just up because. And then here's Microsoft, another $1 trillion company, almost $2 trillion, up 8% here today. Even, typically quiet and boring Warren Buffett and Berkshire Hathaway was up over 5% here today. Some of you might have seen my gif of the old man dancing and kind of joking that was what was happening at Berkshire headquarters here today when I posted that on Twitter. You can see Amazon, another giant that's almost $1 trillion company, up 12% today alone. Here's Tesla, not quite as big as it once was, but still a very hefty $600 billion company, up 7% today. Home Depot was up 9% today. We talked about Home Depot and Lowe's and some of the housing-related companies in my question and answer session today. And that was one theme that seemed to be playing through pretty nicely, with interest rates falling today due to the weaker than expected CPI number. We saw a lot of home-related and housing-related plays surging today, and that's a huge part of the overall economy. So I think that was a really nice benefit to today's trading, as it felt like that was an area that was starting to become a slippery slope, with mortgage rates up there close to 7%. There's a lot less spending that takes place on housing, and remember, there's a lot of feed through in that situation, meaning that it's not just the houses that get purchased, it's all the stuff that goes into the houses. So that is an incredibly important economic indicator, and that was an area that had just run into a brick wall earlier this year because of the ever rising mortgage rates. But with today, us finally feeling a little bit of relief on the long end of the curve, a lot of those housing plays really started perking up once again. So, again, it's kind of hard to pick and choose the bright spots here today, because let's call it what it is. The entire market was a bright spot here today. There were very few down stocks here today, a handful of them in the healthcare space, and a handful of them in the consumer staples space. And remember, those two areas have a lot of defensive characteristics associated with them. So on a day like today, we don't mind seeing those types of companies lower, right? We don't want to be led higher by General Mills. And so we're not upset when it's down a percent on a day like this. We don't want to be led higher by a stock like Bristol Myers Squibb. So we're not upset when it's down 0.5%. right? Those are our sacrificial lambs. Throw away the safety play and get into the aggressive cyclical stuff. And that's what the market wanted to do here today. So it was truly one for the ages. Here's another one I'll point out real quick. BlackRock and a lot of the asset managers were just erupting today. BlackRock was up 13% today. T. Rowe Price was up 16% today. Let me see if I can find Franklin Resources. There's Franklin Resources up 12% today. Those areas had been so woefully out of favor, but just like that, snap of the fingers, you're basically getting back, weeks, if not months worth of difficult trading in just like one day. That's another thing I was posting on Twitter here today about BlackRock specifically, ticker symbol BLK. This is a company that, of course, we've purchased a number of times in my dividend growth investing class over the years, and so it's one that a lot of my students keep a close eye on, and things have gotten a little bit uncomfortable here this year, like they have with a lot of stocks. But BlackRock, in just 1 month, is up 38%. That is unreal to think about. I think that was the number. Let me just verify it real quick here. Where did I post that? There it is. Yeah, it was 38%. And this was, with an hour or two left in trading. So I don't know if this is exactly where it is at the close, but you get the point. You do not see this very often. Again, this is the world's largest asset manager. This is not just a throwaway nobody type of a stock. This is like one of the most important stocks in the entire stock market, up 38% in a single month. Also, I should give a quick shout out to Claire. She has been one of my best dividend growth investing students across the years that I've been teaching it. She was kind enough to share some of her results here in Twitter with some of those screenshots. So if you're interested in that, check out my timeline here today. So good job there, Claire. I'm very proud of you for your ability to hold through thick and thin some of the highest quality companies on the planet, and you are being rewarded for that. Keep it up. All right, let's go ahead and get back on over here to some more breadth numbers now. And I wanted to show you this particular area of the Thinkorswim platform that gives us a sense of how many stocks were up versus how many stocks were down in any given day. And typically what I use for this is the S&P 500. I know a lot of other people will use like the New York Stock Exchange. I prefer the S&P 500 because it is only stocks. Remember, on the New York Stock Exchange, they're including a variety of things that aren't technically stocks, like closed-end funds that have to do with bond trading and different things like that. So I personally view the S&P 500 as a purer form of gathering that data. And in today's case, you can see that 482 out of the S&P 500 closed higher today. That's a 96% hit rate there. So only 4% of the companies in the most important equity index on planet Earth closed lower today. And 96% of them closed up. That is an overwhelming victory for the bulls. And some massive movers as well. That's the other thing that was just, astonishing about today. I looked at our dividend growth investing portfolio that we're in the middle of putting together here for my premium members earlier today when we were in class, and we currently have 19 stocks in there. All 19 of them were up today, and 5 of those 19 were up double-digit percentages. It is incredibly rare to see those kinds of days out there, and it just goes to show you never know when this type of a day will emerge. I mean, heck, if you would have asked me last night if I would have expected this, I would have looked at you like you were crazy. And even if I would have expected a lighter CPI number, which I personally wasn't, but even if I were, I would not have guessed that this would have been the magnitude of the trading here today, for one of the key reasons being what's going on in the cryptocurrency universe, right? We talked about that a little bit on Tuesday when I did the video. The whole Sam Bankman-Fried, controversy and everything going on with FTX tokens and all that kind of stuff, right? Remember, we were talking about Tom Brady in Tuesday's video a little bit. So that has only gotten worse since I was last talking to you. That whole thing has just evaporated with the snap of the fingers. That fella, Sam Bankman-Fried, who was worth, I think it was something like $20 billion at the beginning of the week is basically now bankrupt. So I don't think you'll ever witness that type of evaporation of wealth ever, right? That could very well be the biggest drawdown in basically a single day that you will ever see in your lifetime. So, that is opening up the potential for domino effect or a chain reaction that takes place when people are on the wrong side of the trade and their money is tied up, and you just never know how many more cockroaches come out, so to speak. So if anything, I would have been leaning that today we would have seen more bearishness in the market, not more bullishness. But that's why they play the game, right? You just never know when these types of days will emerge. And that's why it's also important to remind ourselves that the vast majority of Americans and probably people worldwide want stocks to go up. Most of you have your net worth in the stock market, especially your retirement savings. A lot of you have kind of your mad money accounts that you trade back and forth with. But in the end, we should rejoice days like this. We might recognize and think to ourselves, we didn't deserve this, which I'll agree with you. I don't think we really deserve this. But at the same time, I'm feeling pretty good about life here today. And I hope many of you are as well, because we haven't had many of these days this year, right? It's been the bears that have been throwing the parades this year. We finally got one for the bulls here. And so it's nice to have a few of these along the way. I think all of us recognize that the stock market does go from the lower left to the upper right. And in general, we want to take advantage of that concept. But the problem is it can be awfully hard to take advantage of that concept when you get, blasted with, uppercuts and body blows all along the way, like we have here in 2022. It's been a hard year, a tough year. And so it's nice to see a little bit of redemption here on a day like today, even if it means some of your short-term trades don't necessarily go the direction you want. Remember, this is a good thing in general for most people's balance sheets and their brokerage statements and all that kind of stuff. In general, we all benefit when the market goes up. So score one for the bulls here today. It was one for the history books. All right, let's go ahead and now pop on over here to the main part of the platform with some charting analysis. And remember, the way that I typically go through my process for you guys here on these videos is if we ever have a day where the market is up or down more than 1%, I like to get started here on chart 6D to kind of help give you a different visual as to how volatile or not volatile the market is at any given moment in time. In this particular case, what we witnessed today basically blows everything out of the water over the last year. So normally when I bring this up for you guys, we look at a 1 year, 1 day chart. And you will see what the 1 year, 1 day chart looks like here today. Here is the candle that represents today. Not only does it blow every other green candle out of the water, heck, it blows all of the red candles out of the water. And again, that is something incredibly rare, right? Like the worst day that we've had in the last year, which has been a terrible year, is right here. What we witnessed in the middle of September, we were down about 4.32% that day. It looks like this one over here was pretty ugly as well, down about 4.03%. So that gives you a general idea of how bad things have been on the downside. And that really puts things into context for you when you look at a day like this where the S&P 500 was up 5.54% in a single day. So again, not only just destroying all other bullish days we've had in the last year, where there's been 2 other days where I take that back, 3 other days where we've touched a 3% move, right? Right there, back in October, right there, back in June, and right there, back in May. So those 3 days we hit a 3% move. We don't even have a line established for a 4% move because they just don't happen all that often, right? It just kind of would be taking up space, so to speak, let alone a 5% move. And heck, we're not even stopping at 5. We went to 5.5. I mean, this is just unreal. So normally when we look at this to try to get a sense of, well, how do we compare this to other things that have happened in the past? We can't compare this to anything that's happened in the last year because this thing just, blows all the other days out of the water. So instead, let's go back on a 3-year time period because here we will be able to compare it to something. So clicking on the 3-year, now I know this is a little bit tougher to see because we're looking at a lot more data points, but you can see back here during this time period, this crazy, crazy time period. Of course, this is the COVID wipeout time period and then the subsequent recovery, the so-called V-shaped rally that we got that spring and summer. And so we had really chaotic trading activity during that time period. But other than that, today is basically, one of those that you just see every so often, only a few times a decade type of a day. And if we were kind of to zoom in only at that area, maybe you can see it a little bit better. But today's bar, I'll try to point at it because I know some of you watch these videos on your cell phones and stuff, so it's a little bit harder for you to see. But basically right here is where we finished today with a 5.5% move higher. And if you follow my crosshairs to the left, you'll see that the last time we had a day like that would have been this candle way back here on April 6th. And that day, the market was up 7%. But again, a lot of that was because of the extreme selling that we had into COVID, right? That was a 35% drop. And so any 35% drop that results in all-time highs by the end of the summer, just a few months later, is going to have some massive green bars that immediately followed a lot of massive red bars down below. So anyway, this is a little bit different this time around because it's been more of a slow grind lower. Yes, it's been aggressive and it's felt uncomfortable. But, like we've described it in the past, it's like death by 1,000 paper cuts type of a thing. Notice the just wipeout and the destruction of wealth back here during the coronavirus. So it's more natural to have these massive up days when you had these massive down days before it. This one was a little bit different, where we didn't have anything of the magnitude of what we just witnessed on the bullish side today on the bearish side. Right? This is literally the biggest move that we've had in one direction or another since going all the way back here to the spring of 2020. This is not alone for the S&P 500, by the way. Let's go through some of the other major indices. Let's pull up the Qs to see what's going on with the NASDAQ 100. NASDAQ 100 was up 7.38% today. Yes, you heard me correctly. That is, again, just utterly amazing. Look at this move. Right here is the candle. And take a look at my crosshairs. Let me see if I can get it right on there. So that's pretty much the top of today's candle. Look at my crosshairs, take it all the way to the left, and once again, you'd have to go back to the coronavirus time period to see it. And it wasn't even that day of the S&P 500, it was before it. It was this candle. And this candle was on March 24th, which was basically right near the lows of that time period. So the NASDAQ had a better day than even what the S&P 500 witnessed, which went back to April. The NASDAQ, you'd have to go all the way back to March of 2020. And again, look at the size of that green bar right there, and then compare it to everything else on the board other than the coronavirus wipeout. I mean, this is unbelievable. You do not see these days very regularly throughout history. 7%. And remember, the NASDAQ is absolutely massive these days. It'd be a different story if we were looking at the NASDAQ in the 1970s when it wasn't nearly as important. It had a lot smaller market caps. But today, the NASDAQ's where you're going to find Apple and Microsoft and Alphabet. And so, if you've ever heard of the theory of the law of large numbers, you would assume that days like this almost can't happen given the amount of market cap that we're talking about. Yet we just saw it. It did happen. It's reality. It's there staring us in the face. Beyond the NASDAQ, let's take a look at what happened with the Russell 2000 today. This is IWM, the ETF that tracks it. But again, a similar conversation. Notice that the Russell 2000 was up 6.15% here today, so not quite as aggressive as the NASDAQ. Nonetheless, you would have to go all the way back to this candle right here on April 6th in 2020 since you saw a move like this to the upside on the Russell 2000. And then let's also pull up the good old Dow, because remember, the Dow has been the leader up until this point. Now today, it did not lead to the upside, but still had a remarkable 3.66% to the upside. Remember what I was mentioning in Tuesday to you when we were having this conversation, that it is rare to see the Dow leading on the up days. Much more normal is that the Dow will lose less on the down days. That's what's made this more recent move off the lows in the last month a little peculiar, is that the Dow has been the leader. But today it kind of fell back into its normal expectation. In other words, we had a massive up day for the market today, but the Dow is unable to keep up with something like the high-octane NASDAQ. But still, this is an amazing result, any way you slice it, of a 3.66% day on the Dow. And again, look at where my cursor is here. And draw your eyes to the left on my crosshairs. In this case, it looks like we might have had a day like that right there on May 18th of 2020. Yeah, it was. It looks like it was up 3.8% that day, so slightly more than what we saw today. But still, you'd have to go back to either May as the most recent for the Dow, but all the way back to March in some of the other indices cases of 2020. We're talking 2.5 years ago, and we're talking about the aftermath of what history will probably see as kind of a black swan event. And this is not like some sort of a black swan event. If anything, the black swan event, if that were happening today, it would be in the crypto space to the downside, right? So that's what makes this so peculiar. Just a remarkable day across the board. Even the dividend stocks were flying high here today, right? If you look at NOBL, some of you saw my post earlier on Twitter about how there were only 2 dividend aristocrats that were down today. And you had your biggest day since 2020 for this as well. The big old blue chip dividend aristocrat types of companies were up nearly 5% today, right? Obviously, a lot of people buy those for the dividend yields themselves, but tacking on some, 5% of capital appreciation out of nowhere is rather remarkable there as well. And remember, a lot of the aristocrats have already been outperforming, stocks like Genuine Parts and, McDonald's and, Exxon and Chevron, Aflac, those types of companies, GWW, Granger, all of those have been hitting all-time highs within the last week or so. And so we've already seen this area of the market perking up, but today just kind of solidified it even further for a lot of those blue chip dividend aristocrats. So pretty much anywhere you looked, as long as it was a stock, there's a good chance that you're going to be quite happy when you open up your retirement accounts and brokerage statements and things like that here today, if you have exposure to the long side of the market. So a joyous day that, quite frankly, felt like it came out of nowhere. So again, the reason behind it will be the CPI reading, but in the end, I don't think anybody was expecting this kind of a reaction, even if CPI came in a little bit cooler than what people were thinking. Let's go ahead and pop on over here to our main 4 grid here now and kind of see what this means for postures, because a monumental historic type of a day like this is going to have the ability to basically change everything, right? Doesn't have to. It's just that this is the type of day that could certainly be looked at. We might look back on this a year from now and say that was the day everything changed. November 10th, 2022, was a dramatic day in the market and really changed the sentiment of the market. Again, I struggle with this, not because I don't want the stock market to go up. I love today and obviously doing well with my long-term accounts. In fact, my Roth IRA literally hitting all-time high value today. So I'm tickled with that. My trading account, not so much. Had a few swings and misses there where I was not expecting this type of a day. That's okay. You live and you learn with some of that stuff. But in general, my struggle with this is my mindset is that you should not fight the Fed. And the Fed, I think, if anything, is going to view this market rally with a little bit of difficulty. In other words, in a lot of ways, the Fed would like to see the economy cool down. And it knows that one way to get the economy to cool down is to have the stock market cool down, if not outright just get wiped out. And so, I debate in the back of my head, like, well, where are we going to go from here? This is a very important thing that we're witnessing from a technical analysis perspective, but sometimes our minds can get in the way our best intentions. And so my mind still struggles with this idea that the Fed is not going to like what happened today, and if anything, the Fed might very well have to get more aggressive with rate hikes going forward. But we did see a reduction in some of the various time periods when it comes to the interest yields that were out there. So I think the hope from the marketplace today is, if the Fed is reading the same CPI report that the market did today, then the Fed will be more incentivized to kind of loosen their grip and maybe get a little bit more dovish than they have. Now, whether they deserve to have this massive rally that we had here, I think that's debatable. And I think a big chunk of this is probably short covering as well, because there was fear in the marketplace today, but the fear wasn't from the bulls like it had been all year long. The fear was from the bears. I mean, this is the type of day that can scare you straight if you are short this market, right? Because this is kind of like a runaway freight train possibility here. Notice like on the S&P 500 and on the Dow Jones, we're breaking out to multi-month highs. We're not quite there on the NASDAQ and on the Russell 2000 yet. The Russell almost got there, and actually on a closing price basis, you could say that we did, because we closed basically near the high of the session on the Russell. But you can see that we have this prior topping point here from the beginning of November that could effectively become a double top, right? The momentum right now is with the bulls. So if I were a betting man, I would bet that that gets taken out. But you could also see where if tomorrow we wake up and there's a gap down on the markets because everybody comes to their senses, that could be viewed in history as a double top. So we'll keep our eye on it. Same thing with the NASDAQ. Notice the NASDAQ had an impressive day, up 7.35%, one for the ages. The problem is the NASDAQ looked like junk before today. And so the harder they fall, the harder they could bounce. And that's what we're experiencing there with the NASDAQ today. So despite the NASDAQ being by far and away the leading index here today, it is still the one that is basically sitting right at resistance at this point. Not only this resistance from late October, early November, like the Russell 2000, but also remember this other resistance point over here from the beginning of October. So we have not taken out those levels quite yet. So of these charts, it looks like the Dow is still a very bullish chart, which has been the case. Remember, we've talked about that endlessly, that the Dow has been extremely resilient and extremely impressive. The S&P 500 prior to today really didn't want to get too excited about it, right? Because it just hadn't proven it to us yet. But it did a lot of work in proving it to us today. A 5.5% move up. And in doing so, closing at the high of the session, and in doing so, taking out this prior resistance area right here. Now, we still got work to do, right? We're still a long ways away from all-time highs, right? But you got to start somewhere. and you're looking for powerful moments in the market to see when that really gets going. And again, today was a powerful day. Are there flies in the ointment? Of course, there always are. Would you want volume to be heavier today? Of course you would, right? You can always nitpick here and there at the market, but sometimes the truth is staring you right in the face. And right now, what we're seeing is very constructive activity on the charts. Notice that the move on the S&P 500 was so aggressive today that you went back to a strongly bullish posture. Notice that green line nearly went back into the upper reversal zone in one fell swoop. And of course, we've stayed with that green moving average this entire time. Remember when I was with you on Tuesday and we were talking about the trade application example, and I was saying, well, I'm kind of in a struggle right now because my mind tells me not to fight the Fed and that I fear that there's still more bearishness on the horizon, but my eyes are telling me that there's actually stabilization on the chart. So that's why I opted to do the Iron Condor on Tuesday, because I just couldn't figure it out myself. Do I want to be really bullish? Do I want to be really bearish? I kind of came up with X's in both of those two, so I decided to go neutral. But the point that I'm making for bringing that up is we were seeing that on Tuesday, right? We were seeing the fact that we had 3 days in a row off of that rising moving average. We continue to be that way. Even yesterday, after a pretty big sell-off, and I think it is a fair point that I should bring up as well, just to remain objective here, right? That's what we want to do. part of the reason the market was up 5.5% today is because it was down 2% yesterday, right? So it would be maybe a different story if the market were up 5.5% after being up a whole percent the day before. But part of this 5% move is just simply making up for the 2% we lost yesterday. So that's part of the story there as well. But nonetheless, it was a powerful day. And even after yesterday's 2% pullback, we didn't breach that moving average. Remember a few weeks ago I was saying what I'd like to see is for the market to stabilize above its moving averages. Then I'd be willing to get a little bit more bullish. And for all intents and purposes, that's kind of what's happened. It's been clear, crystal clear, that it happened with the Dow. There it was never really even a consideration. As soon as we got above the moving averages, we were trading well above them. So the Dow has been really bullish this entire time. Where my debate in my head was going back and forth were on the other indices. And of course, the S&P 500 is a more important index than the Dow. And so that's where you really want to focus most of your attention. But even that, I got to give it credit, right? Back here, we touched that falling 30-day moving average. We immediately rejected it. You could tell the market had no desire whatsoever to be bullish. This time around, you had that opportunity to have that moving average rejected again on this candle. Remember, we talked about it that day. I think I was the one that was with you that day. That was a big bullish engulfing candle. It was, one that, a lot of people were talking about, right? We saw these other big bullish engulfing candles and things like that. But you had that opportunity on this one to say the same thing as what happened back here. In other words, reject it at that downward trending 30-day moving average. But that's not what happened. That was in the midst of a 3-day rally. And it gave us I think the term I used was the ground cover because what it did is it allowed us to have this air pocket between where it was trading and the 30-day moving average. My fear was that if we just got a little bit above it, that there just wouldn't be enough market support to sustain it. So I was feeling a lot better about things on this move right here where we got that air pocket. Then, of course, after Powell spoke, then unfortunately my enthusiasm went away because we had that nasty 4-day sell-off and we went right back to the moving average again. And I'm like, ugh, now we really have to debate, are we going to be bullish or are we going to be bearish here? Now it's kind of a coin flip, right? Whereas over here, it was looking much more positive. Well, we bounce off of it. And that's what you want to see, right? If you're bullish, that's the behavior you want. You tested that opportunity. We talked about it. Remember, I talked about it with the Russell 2000 particularly, where you had that sell-off and where you sold off to was the top side of that previous resistance. And what you want to see is kind of that breakout retest mindset. And the Russell actually tested it twice. It tested it yesterday at the close and, of course, tested it the week before, but it didn't breach that area. And in a lot of ways, it's kind of like building the strength. It's you're testing the market. And you did that to a degree with the S&P 500 as well. It's just not as textbook as what you saw with the Russell 2000. Nonetheless, it was impressive that the S&P 500 did not easily breach that 30-day moving average. And instead, when given the choice, when it could have just given up and fallen back into that downtrend, it decided to bounce. So that was important as well. That 3-day rally right there, again, fizzled yesterday. So again, it's never as easy as it seems in hindsight, right? But what we do know by looking back at this is over the last, 2 or 3 weeks, we have spent nearly all of it above the 30-day moving average. And that has led to this massive opportunity that bulls received here just on a silver platter here today. It's not quite as obvious with the NASDAQ, as I mentioned before. And that's, again, a challenge, right? You're trying to put all this stuff together and you're trying to, go with the weight of the evidence, knowing that there will never be a time where everything points to bullishness and there will never be a time where everything points to bearishness. There's always data points in both camps. It's just you're trying to, weigh the evidence there. And, the evidence certainly got a lot heavier for the bulls here all of a sudden with one fell swoop. But the problem before was the NASDAQ was such a leading index for so many years that, it was disappointing, to put it mildly, to see it struggle the way that it had recently. because that's where you got your heavy hitters, your Microsofts, your Apples, your Googles, your Facebooks, and all those kinds of things. And so this was really choppy, ugly behavior that you don't want to see out of the markets if you want to be bullish. So, while it was nice to see the S&P 500 do its thing up here above the moving average for the last 2 or 3 weeks, it was a disappointment and somewhat offsetting for the bears that the NASDAQ was not able to follow suit. But with today's move on the NASDAQ, if we get a follow through of this move here tomorrow or early next week, there's a pretty decent chance we could start taking out some of these major resistance areas here for the NASDAQ. And of course, as we've mentioned, we're in the bullish time of the year from a seasonality perspective, right? The best 3 months of the year is typically November, December, January. Whether that follows through in any particular year is anybody's guess, but on average throughout history, that's your best 3-month period. So I think that helps set things up and makes us feel a little bit more comfortable as well. Obviously, we still got plenty of things to worry about out there, and that will always be the case, right? The markets climb the wall of worry throughout history. Sometimes it's deserved, sometimes it's not. And my fear, again, is that the Fed is going to look at a day like today and say, don't want to see that. And therefore, they might have to continue to raise interest rates further. But maybe, just maybe, they can pull off this whole soft landing thing that people have not been willing to give them the credit for prior to this moment, right? With the idea that, yes, we can try to slow down the economy without crashing it. And maybe that's what the stock market is trying to pick up upon on a day like this. So we are back to bullish postures across the board. And guess what? For the first time in about 2.5 months, I can make this statement. All 4 of these charts have a green moving average at the same time, because finally the NASDAQ got there to join the rest of the party. And that happened as a result of today's robust trading. So notice the moving average of the NASDAQ has now curled higher with price being above it. That had already been the case for the last week on the S&P 500. That had already been the case for the last 2 weeks on the Russell 2000. And that had already been the case for the last almost 3 weeks on the Dow Jones Industrial Average. It was really the NASDAQ that we were waiting for. And today we finally got that. So this is the first time I've been able to say for many months that all 4 of our indices have a bullish intermediate posture. And all 4 of our major indices here in the U.S. have price above rising 30-day moving averages, and those are generally perceived bullishly. So what a day, what a day. One to remember. All right, let's pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free videos that you watch here on YouTube. As I always say, it takes us about 3 hours all in to do these videos. And so since we don't really make any money off of doing the videos, some would question our sanity for continuing to do the videos and chewing up 3 hours out of our day. All we ask out of you is to help support us with our efforts. And if you get value out of listening to our presentations and having us break down the markets and all that kind of good stuff, we just simply ask that you click like for us there on Twitter. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video the next time I'm scheduled to do it. If we're under 100 likes, then I would just plan on saving myself a lot of time that day by only doing a 15-minute version with no trade application example, because that would save me a lot of time in terms of the research that needs to go into the prep before the video. So anyway, you guys stepped up to the plate once again, as you have so often this year, and I thank you for that, with 107 of you clicking like for me the last time around. Let's give some shout outs there. Let's say thank you to Leah. Let's say thank you to Roger and Carl and Brandon and Martins and Robert and Trunk and Dennis and George and Brian and Common Sense Investing and Arth and Ken, Marley and Evan and Phil and Venkat and Patian and Dave and Investing Quotes, Tom, HR, Richie, Kirk, Ayakipa, I can't get through all of you. It would just soak up too much time, but I do want to say thank you to each and every one of you that took the 5 seconds out of your day to say, I appreciate the 3 hours that you took to prepare this for us, Brandon. Would you please do that for us again next time around? And as long as we're up and over 100 likes by the time I'm scheduled to do the video on Tuesday next week, I will plan on doing another one of these full-length videos for you. If you prefer the 15-minute version, then feel free to not click like, and we will go that direction as well. Either way, I'm fine with. It's a matter of what do you guys want collectively. All right. Also, while we're over here on the internet, let's take a peek here at the factor selector. Remember, this gets put together on Tuesday evening, so it is a little bit stale at this point. It did not include today's massive move in the market, which has the potential to shake up rankings, but that will be included in next week's graphic. So for the 6th straight week, we had momentum leading the way on the top side. Momentum has effectively been traveling in whatever direction energy stocks are traveling. So as long as energy stocks can stay strong, there's a pretty decent chance that momentum will as well. Now yesterday, energy stocks were down quite considerably. They snapped back with everything else today, but that is one thing we're going to want to keep our eye on, because that one seemed a little bit out of the ordinary to me yesterday. So who knows, maybe energies had their fun and they need to kind of pass the baton to other groups that are out there, like, you know, industrials and things like that. But for at least one more week, we do have momentum up there in the top slot for the 6th straight week. We did have dividend yield making its way up to the number 2 position. You know, I mentioned the dividend aristocrats earlier and a number of those stocks that are hitting all-time highs, and so I'm sure that helped their cause there to a degree as well. On the downside, we do have quality once again, but again, I'll emphasize that was before what happened today, and it's important in this case because quality usually is driven by whatever is happening with technology stocks, especially stocks like Apple and Microsoft. And so with those companies up huge today, they might be doing better than some of the others on a relative basis. And so it's possible quality could get off of the basement ranking there when we redo the rankings next week. So we'll keep our eye on it. But otherwise, week over week, it was pretty much the same old there on the bookends on the top and on the bottom. Also earlier today, we had a good conversation in our question and answer session, as we always do. Got a question about looking at Stanley Black & Decker as a dividend play. And of course, that stock was up over 10% here today as a housing-related theme. And again, as I mentioned earlier, with interest rates coming down, that really spurred on the bullishness in anything housing-related. And of course, a tool company like Stanley Black & Decker is going to be kind of an ancillary play to the housing market. We also had a question about Lincoln National, which is an insurance company, as a potential dividend growth investing candidate. We spent a lot of time talking about T-bills here today. In fact, we spent more than an hour of today's 3.5-hour class discussing T-bills, because that has been a hotter topic here recently than it had been for quite some time. So if you want to learn from my experience of participating in the Treasury market last weekend in some of the Treasury auctions, feel free to listen to that response. It starts at the 1 hour and 34-minute mark of today's recording. And again, this is something that's available to all of our premium members, right? So that's a nice perk that you get when you sign up for our 3-year premium package. Of course, we teach 10 classes throughout the week, but this one and David's Saturday morning class is kind of unique, where it's only available to the premium members, not the plus members. And it's a way for our students to work directly with David and I and ask us direct questions and have us kind of air our thoughts out about the topics that they're interested in. And then I also got a question about looking at some inverse ETFs as, you know, opportunities to hedge against, the market moving forward after having such a big day like today, if you don't believe that the rally will hold. So if you're interested in any of that, make sure you check that out. It is now recorded and posted up here, as all of our classes are, on the Trading Rooms tab. David taught his portfolio management with ETFs class, so make sure you check that out as well. Also, I wanted to quickly pull up the 3-month Treasury bill. We were talking about this in my class earlier today, as I just mentioned, and I wanted to point out that the 3-month Treasury bill hardly budged here today. Its yield remains elevated at 4.18%. Now, you might be wondering, well, wait a second, Brandon, I thought you just said that yields were falling today. Well, technically, this one did fall, but just barely. But really what fell today were the longer-term yields. The 10-year yield, as an example, fell much more dramatically. So one of the unique things that happened today is that the yield curve got even more inverted. Remember, it was already inverted before today, but with the 10-year yield falling even more aggressively and the 3-month Treasury bill remaining elevated at 4.18, to compare that to, let's just pull up the 10-year Treasury real quick, TNX. Actually, since we're at this stage of our conversation anyway, let's just pull up our asset class 12 grid, since we look at the 10-year Treasury yield pretty much every single time I do these videos. It's the one in the lower right-hand corner here. And you can see that we had quite the healthy pullback in yields today. The 10-year Treasury yield closed at 3.82. And then again, compare that to the 3-month Treasury bill at 4.18. The 3-month Treasury bill has a way higher yield than the 10-year Treasury yield does right now. And that is not normal, right? That is a heavily inverted yield curve. In fact, we have one of these charts dedicated to that here, which is chart 4I. For those of you that are premium members, remember one of the perks you get is access to all 50 plus of the charts that David and I use. And this chart will kind of give you a sense of whether different time periods of maturities are inverted or not. One of the main ones that the media likes to track is the 2s and 10s, and that's down below. So when this blue line is below this pink line, it basically means we have an inverted yield curve at that moment in time. But even up here, you can see that, right? Like if you were to look at the 3-month Treasury yield here in the red, and then compare it to the 10-year Treasury yield in the black, in a normal market environment, let's go back to this time period that you see kind of in the middle of the screen right here. Notice that the black has a yield higher than the red, right? And that's normal, right? The way this should work is the orange should have the highest yield. Like back here, orange had the highest yield. Blue should have the second highest yield. Blue has the second highest yield. Black should have the third highest yield. Black has the third highest yield. And then, so on and so forth until you get down to the red, which is the shortest term one that we track here as the 3-month T-bill, and that should be the lowest yield. And that's what you see in normal market environments with this red line at the bottom. We'll take a look at the difference of normal versus what we're dealing with right now. Now you have the 10-year Treasury as basically the lowest yield, and this hasn't even been updated with today's drop yet. But you have the red line. I think it's right here. It's kind of hard unless I zoom in. Here's the red line, red line, red line. And right now you can see the red line is above the black line. So that's effectively saying that this is an inverted yield curve. In fact, the 3-month and the 30-year basically have identical yields as of this chart. Again, it has a little bit of a delay on this one because it's got to get the data from the Fed, or from the Fred, I should say. But point being, that was one thing that caught my eye here today that was a little bit peculiar as well, is that the bond market wasn't fully having this rally that the stock market was in the midst of participating in today. Not only do we remain with an inverted yield curve, it got worse. So that was quite unique. Another thing that's probably worth pointing out is what happens with the VIX on a big day like this. So let's just pull up chart 3A here real quick and type in VIX. And you can see that, as expected, the VIX got smoked here today. It was down about 10% here today, which is a pretty aggressive day for the VIX. Remember, we've had a couple of those days in the last month or so where we had an up day in the market, but the VIX really didn't budge. And it kind of happened the opposite way a couple of times too. But today was a very aggressive day, and it acted the way that you assume that it would act. Kind of put that move for the VIX in context. Let's go back over here to our chart 6D and pull up the VIX on the main chart up here so I can show you that this was a pretty substantial move in the VIX that we saw today, right? With this red line, this was basically the biggest move we've had in the VIX to the downside since going all the way back here to May, right? So for a half a year, we have not seen a pullback in the VIX like we just witnessed here today. And that's what you would expect, right? Today was a monumental victory for the bulls. This should be a day when the VIX gets annihilated, and today it did. And now all of a sudden we're down here in the low 20s. Remember, for a while we were talking about the VIX up here above 30, but we've had this grind all the way down here to the low 20s now, where the VIX ends today at about 23. Let's go back over here to the 12 grids again, because I wanted to kind of finish up on that conversation. And remember when I was with you on Tuesday, I was talking to you about the importance of what was happening to the US dollar at that time. It was on this candle right here, and I was saying, holy cow, this could actually be breaking down right now. Now, I didn't know what was going to be happening in the next couple of sessions, but I was just basically reading the charts. Now, to be fair, I said that I was not seeing the same thing out of Treasury yields. We hadn't seen that breakdown yet. But I was saying that the dollar looked like it was on the verge of breaking down. And this initial one I was willing to give them, a little bit of wiggle room with, because we had two other times during the year where that dollar stabilized at around the same area and then bounced up. But when it came right back there just a couple of weeks later, right here again was Tuesday, I was mentioning how this could legitimately be a breakdown in the US dollar. And since that was one of the things that was really causing bearishness in stocks, if the US dollar could break down, that would be a jubilation type of event for the US stock market and for other stock markets in foreign countries as well. And that is what we saw today. Major breakdown there in the dollar, down over 2% against a basket of other currencies. And you can see we're trading on the dollar to levels we last saw back here in September. So that's a major move. And what ended up happening is the dollar basically drug Treasury yields down with it. Remember, on Tuesday, that was not the case. On Tuesday, Treasury yields were still up here. And I'm like, yeah, there's a little bit of wear and tear there. You're still below that prior high, so you never know what could happen. But today, it's a lot more evident and apparent. This is a major breakdown in the 10-year Treasury yield as well, where you took out that support from the end of October there. It still doesn't look nearly as bad as the US dollar. Notice the US dollar has a red moving average right now. Price is well below that falling moving average and has been for the last week. So far in the 10-year, because today was really the big meltdown day for it, we haven't seen an actual change in that 30-day moving average yet. So we'll see where that takes us. But we're kind of at a place right now in the 10-year Treasury yield where I felt like we were kind of at on Tuesday with the US dollar. So there is that possibility for a continued breakdown in Treasury yields and the US dollar, and both of those things would be supportive of bullish stock prices like we saw up here. It wasn't just the US market that was rallying today. Developed foreign stocks were up more than the US market at 5.6%. Emerging markets did not participate at the same level, but still had a very robust 3.6% move here today. And of course, when Treasury yields are breaking down, those are big days for bonds. Notice that the long-term U.S. Treasury got back up to its moving average and closed slightly above it. So that's why that moving average changed to yellow. It closed slightly above it, even though the moving average is still going lower. But look at the action is healthier on foreign bonds and high yield bonds, where we actually have not only dark green background colors as opposed to light green, but we actually have a green moving average on both of those as well. So there's more constructive activity taking place here on these other bond categories, where you could almost say that these are reversal types of patterns that are taking place down here, where you've got a left shoulder, you kind of got like a Batman head right there, and then a right shoulder. That's a reversal pattern that's kind of breaking out right now on foreign bonds there. And again, remember, risk appetite is what we're interested in when we look at something like high yield bonds. High yield bonds up over 3% today. That's a good sign there as well. In fact, they might have been up even more, but oil prices really didn't participate much today. Gold prices went crazy, right? Gold prices went gaga to the upside, up another 3%. Remember, we talked about that on Tuesday as well with that huge candle right there. So there is definitely a major sentiment change taking place there in gold right now. And part of it might be because, a lot of the cryptocurrencies are struggling so much, right? And just this week, Bitcoin went from 20,000 to 15,000 and then had a little bit of a bounce here today, up 7%. And so some stabilization at around 17,500, but that was a really ugly wipeout there. And remember, Bitcoin is usually the most liquid cryptocurrency. A lot of the other lesser known cryptocurrencies truly were evaporated here this week. And so it almost makes you wonder, is some of that money from cryptocurrencies going into the kind of original alternative asset of hard assets like gold? And it seems like there is something to that story right now. Notice that gold has not only a strongly bullish posture, but also is above a rising moving average. Let's quickly check in on the sectors, and as I'm sure you can imagine, all of them were just crushing it here today. Clean sweep across the board, not only in one-day performance, but you'll notice that with today's rally, all sectors now have green background charts telling us that we have strongly bullish postures across the board. Discretionary did really well. It was up 7% today. Technology did even better. It was up 8% here today. Those are monumental numbers. I mean, heck, look at real estate. Real estate was up 7.6% today. Usually real estate is a big day if it's up 2%. This is huge. And look at utilities, up 5% today. That's usually the most boring area of the market. But remember, utilities and REITs benefit when interest rates go lower, which is what we saw today. So that leads me into my trade application example for the day. So I'm going to bring up chart 3A here. And I'm going to pull up ticker symbol NWN. This is Northwest Natural. This is a company that many of you probably have never heard of before. It's a pretty small company. It would be considered kind of a $1 to $2 billion market cap type of a company. As the name insists, they have a utility operation up in Oregon and Washington State and what have you, up in the Northwest. It's a natural gas utility, but they do have a little bit of water utility exposure there as well. This is a stock that's somewhat more popular amongst us dividend growth investors because they have one of the longest streaks of dividend increases known to man. In fact, let me show you a slightly different chart here. That will be a long-term chart. And as we pull up NWN on my dividend stair-step chart here, you'll notice that it's in the blue zone of that dividend stair-step chart, which effectively means that its shares are attractively priced here today based solely through their historical yields, right? You want to buy when it's in the blue, and if you're ever going to sell, you'd want to do so when it's up here in the orange. So think of orange as overvalued, blue as undervalued. And like so many utilities, they benefited when interest rates rolled over today, and this stock was up about 3.7%. But because it was so far in the blue zone to begin with, it still remains in long-term value territory, all else being equal. But of course, in this presentation, we don't really focus on the long term as much as we focus on the short term. So that's just more kind of supporting evidence there for long-term investors. What I did in this particular case is a short-term swing trade with it. And the reason I decided to go with just this chart, because to be honest with you, I was looking at a lot of different charts. One of them I almost did was FE. This is First Energy. This is a stronger utility here, but this darn thing just ran away from me. I was trying to get filled on a trade for the last half of an hour, and it just kept on going up and frustrating me. And so anyway, I had to kind of pivot here at the end of the day before the closing bell. And I decided to go with Northwest Natural, partly because it has what's known as a bullish divergence signal here if you're using this blue near-term line down below. Notice you had a low on the blue near-term line right there on November 3rd. You had a follow-up low on November 8th. And so we had a higher low on the underlying indicator. At the same time, we had a lower high on the price activity up above. So prices were going down at a time when the underlying indicator was showing more resiliency. And so that's telling you that underneath the surface, there's a little bit more bullishness than what you would perceive solely through price activity itself. Now, another reason this one kind of caught my eye today is that just yesterday it went to that bullish posture where that background color went from pink to blue using this chart 3A that we use for my swing trading class. And of course, they just reported their earnings, and we closed at the high of the session today like so many other stocks did as well. You'll also notice that it has a green moving average, telling us that price is above a rising moving average in this particular case. This one has not outperformed the S&P 500, so that might be a bit of a fly in the ointment. But then again, maybe it's a candidate for a catch-up trade, right? And you can see that the intermediate line is at 53 and rising here as well. So that green line did fall out of favor a couple of weeks ago, but has now started to rise once again. So we do have all 4 of these labels that say rising in them, which basically tell us that there are multiple groups of traders that might be interested in the merchandise here. So we'll see how that goes. Because this one is such a small company, I didn't want to do an options trade on it. So this was purely a stock trade where we bought the shares here today, and then we put our stop loss below the low of this candle here on November 7th, and then we do a 1-for-1 reward risk relationship. So whatever risk we're taking to the downside, we basically add to our buy price. And so somewhere up in this general vicinity here, I think it was a little bit below 50 bucks if my memory serves me correctly, would be where our target price is. Remember, if you're a premium member, you have access to our private Telegram channel where we do the screenshots of the trade executions and the fill prices and all that kind of stuff. So if you need the details on that, that would be a perk you would have as a premium member of Market Scholars. But that was the basic idea of today's trade application. Take advantage of that bullish near-term divergence on a sector that should benefit if interest rates continue to fall, and then shoot for a 1-for-1 reward risk relationship where we don't require a breakout to new yearly highs. We just need it to get a little bit of juice here in the next few weeks. And as an added bonus, this is a stock that would be considered undervalued from a long-term dividend growth investor's perspective as well. Okay, so that's what I had for you here tonight. If you got value out of that trade analysis or the other statistics that we talked about with today's historic day, I have one simple request out of you. Take the 5 seconds out of your day to click like for me there on Twitter. Remember, you can do that directly on Twitter at the top of my timeline. You can click like in the little Twitter widget underneath the video if you're watching this video on our website at marketscholars.com. There is a link in the description area of the YouTube video to the tweet in question for those of you that watch this video directly on YouTube. And then last but not least, there is a Twitter icon at the bottom of the emails that you guys receive that will also take you to the tweet in question. So whatever one of those 4 approaches you take, whatever's easiest for you, we do appreciate that. That helps support us and gives us incentive to do these free videos for you as often as we do. As long as we're up and over 100 likes by the time I'm scheduled to do the video on Tuesday, I'll be happy to give you another full-length version like this. Otherwise, if you prefer just a 15-minute version with no extra analysis and no extra, trade ideas and things like that, then don't click like, and we'll go with whatever the majority is or what side of 100 we get to. Okay, so with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.